Well, December tends to be a strong month for equities, but as we head toward the year end, is it complacent to think the relief rally will be enough to carry us through until January? Yesterday's sell down was food for thought, with the S&P and Nasdaq posting their biggest pullback since November 9th. So, what happens between now and the inevitable year-end boost from Santa Claus? Joining us to discuss the Simeon Hyman, ProShares global investment strategist. Simeon, as I was saying at the top of the show, it feels like the market is firmly focused on that next FOMC meeting and just how quickly those rate hikes will come. Any chance we could get a bit of a relief after going into year end?
Well, I think we're waiting for the Fed to move, but the bond market has already moved in and of itself. We had a massive rally in treasuries over the last couple of months, and that had a mathematical expansion of multiples. So I think the real question for next year is when the bill comes due in terms of earnings, who's going to show up and have their margins hold up in the face of what's likely to be at least some persistent inflation, maybe not 8%, but maybe it's 4 or 5.
And so with that said, I mean, how are you kind of positioning yourself going into year end? We keep talking about the Santa Claus rally, which we come to expect, but it feels like there's a bit of a different feel to December this year.
Well, I think that's because we've seen that margin compression already happen in the S&P 500 in Q3 earnings season. We saw top line growth in the S&P of 11%, but bottom line of only 3%. And that's concerning as we go into 2023 when we already have a 20 times trailing multiple. But there are pockets of the market that are holding up. The S&P 500 Dividend Aristocrats, our ETF Noble, actually delivered 26% earnings growth in Q3. So if you can show up with some pricing power, it could be a much better 2023.
And Simeon, are there any risks that you think the market isn't correctly pricing in at the moment?
Well, look, after a 70 basis point rally in the 10-year Treasury, I think people might be getting a little complacent with regards to interest rates. We still have quantitative tightening out there, and that still leaves an opportunity for that longer-term bond yields to creep up a little further. So I wouldn't get so complacent about longer-term interest rate risk.
Let's talk more specifics in terms of sectors that you're watching. You highlight this ETF on companies mining battery metals. I mean, this is kind of an area that we've been talking a lot about, especially with the push towards electric in that direction. Talk to me about what you like there.
You have to have some exposure to some growth opportunities in a portfolio, even if you're a little worried about whether it's interest rates or the economy. And with ticker ION, and that's the S&P Global Core Battery Metals ETF that we just launched at ProShares, we think there's a real opportunity. This is the first ETF that invests only in the companies that are mining battery metals, focused here on lithium, cobalt, and nickel. And we know the story. We know the EV story, the consumer electronics story, the storage, the energy storage story. So we know what's going on there. Lithium prices basically doubling this year. But the miners are an interesting way to get this exposure. First, they own the rights to the resources, so you can't just go in your backyard and dig for lithium. And second, here's a really good one. Most of these companies make money. And how about that for an interesting way to approach the space, as opposed to a lot of the electric vehicle manufacturers who don't turn a profit yet. The miners make money today. So we think this is a very interesting way to get exposure to the surging demand for battery metals, and it deserves a look for that growth slice, even going into an environment where many investors may be a little wary about growth exposure in their portfolio.
Now, you talk about perhaps taking on more risk. I want to ask you about crypto at the moment, given some of the fallout that we've seen and concerns about a crypto winter. What is your take on the investment space there?
It's very interesting. If we look at the last month plus since the collapse of FTX, we see a couple of very interesting things that stand in contrast to one another. We see a continual flow of challenging information about the crypto exchanges. They're unregulated. We're finding out that there may be commingling in certain exchanges of funds that were supposed to simply be custody versus those that were lent and earning interest on them. We also know that at the exchanges, there, even in the absence of any malfeasance, that there may be no segregation of assets in the event of bankruptcy. And we keep getting those stories. And in the meantime, after that first week of FTX, Bitcoin's up 1.7%. So I think that tells you some resilience about Bitcoin itself. And the futures market has behaved really, really well. We have our ETF BITO. It's our Bitcoin strategy ETF that uses futures for exposure. And the futures market has matured quite nicely while the exchange market's kind of gotten a little immature. The roll costs have fallen 80%. We're tracking Bitcoin very, very well. And you have the belt and suspenders of a regulated futures market and a regulated ETF. So I point out that real contrast between the continuing challenging stories of the exchanges versus the relative stability of Bitcoin itself.
Simeon Hyman, as always, good to have you on the show. ProShares Global Investment Strategist.